Welcome to This Week in Money. I'm Jim Goddard. Today, Chartworks CEO Ross Clark comments on whether the drop in the stock markets is over and whether we saw a flight to so-called safe havens like gold. InsideTrack.com President Eric Hadik examines what role cycles played in the market downturn and what we can expect in certain sectors like oil, copper, and gold. Mike Shedlock from Mish's Global Economic Trend Analysis talks about cryptocurrencies and their recent crash. He also comments on how deep the decline in the equity markets could go. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Carl Data Solutions CEO Greg Johnston. We'll talk to Ross Clark right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799. I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's the CEO of Chartworks. Welcome back to the show, Ross.
Good to be with you, Jim.
Is the bloodbath on the stock markets over, or is this just a temporary reprieve that we saw on Friday, at least for the U.S. markets?
I think that more volatility is still ahead of us, although personally I think that the bulk of the decline is behind us at this point. When we've talked about these stretches of low volatility with high upside momentum that go on, in this case like for 2 years worth above the 50-day average, when you break, the typical breaks are in the 8 to 14% variety. We've now done 11% on the Dow, so that's normal for what you would see. And you would have at least usually 1 month with a lower low, which we've now got. And 80% of the time, that month's low becomes the low of the initial correction. And a small number, you go on to have a marginally lower low in the second month, and only 4 that we can look at going back over 100 years have actually continued on into bear markets. So the norm here is that we would be thrashing around probably a 6 to 8 week stretch, and we are now better than a week into it, and then probably resolve back to at least testing the high, if not trying to take it out.
Did precious metals receive a boost? Because usually if there's market problems, people like to resort to safe havens.
Oh, yeah. Flight to safety typically would involve U.S. bonds, but we've got to remember that the bonds were one of the big problems here with interest rates moving up. And the other item would be precious metals. And, you know, you take a look to see how does something react relative to what you would anticipate. And in the case of gold, a week ago, we were sitting at the 1330 to 1340 level. This week, we ended up with sort of 1330 on the top end of it, down to 1310 or 1312. This is not good for gold. If it can't do well during these volatile times, then the probability is that it's going to give up more ground. And our work looking at that 8-year cycle suggested that we were 58 weeks into what is normally a 55 to 64 week rally. It was time for the correction, and now that we've had a weekly low that's taken out the previous 2, that would suggest that this thing's going to have some momentum to the downside, definitely under 1300 from the work we do, more probably towards 1270. If we can get oversold down there, this is really good because we've got a big saucer bottom over the last 2 to 3 years that's in the formation in gold. And if we can start to see it find support at the correct levels and make a turn, this thing's got a lot of life in it on the upside. And what we'd like to see, as I say, is an oversold, but it would be also to see the miners show some resilience. And if you look at the GDX or the GDXJ ETFs, they have been under pressure all week long. There's no sign yet that we're going to have anything more than just a minor bounce in here.
How did crude oil go through this stretch?
Oh, well, this was one of the rougher weeks for crude, no question about that. And the oil itself, we're down now at the $59 level, having been up over 66 just a week and a half ago. But if you take a look at what's happened to the stocks, so you take a look at the XLE, the big U.S. ETF, or the XEG in Canada, we're getting big, important downside capitulations readings right now. Only see, and we saw them in 2015, we saw them in 2014, and back in 2001. This kind of sell-off is really important from our perspective. You should see a good bounce here. Would look for anywhere from maybe a 3 to 6 week bounce in the oil stocks, and the norm would be that they recover 38 to maybe 45% of the decline that we've had. That won't. It implies that though that we haven't seen the final low on this break. After the bounce, you're probably going to go back down and take out the lows that we've just put in this last week. But for traders, this is probably a pretty good spot to look at.
What's the outlook for the Canadian dollar if oil goes lower?
Well, it's, oil used to be just extremely tightly tied to the oil market, but the Canadian dollar now, there's less of a tie to it. There's no question that if commodities in general remain weak, that it's going to have some pressure on the Canadian dollar. And I think also the spreads here on interest rates are a key item to be looking at. For interest rates, we had looked at a year ago, 14, 15 months ago, as an important low in bonds. It was to be back and retested within the next year, which is what they've done. But now they've taken out that low. And this is major change in character. If we look back over 30 years of bull market in bonds and lower interest rates, unless prices change this month, unless the bond market can reverse up and interest rates reverse down, which I doubt, we've clearly seen the end of that 30-year decline in interest rates. And if that's going to happen, Canadian rates better go up at the same pace as the U.S. ones, or the Canadian dollar is going to be under pressure.
Ross, thank you so much for being on the show.
Always nice to be with you, Jim.
My guest has been Ross Clark, CEO of Chartworks.ca. Coming up, InsideTrack.com President Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. My guest is Eric Hadik, president of InsideTrack.com, Inside spelled INSIIDE. Eric, before we start asking questions, why the unusual spelling for Inside?
Inside is an acronym for the primary markets that were the focus when I started the service a couple decades ago, and it just was an acronym that kind of combined inflationary markets, stock indices, interest rates, the dollar, and energy markets. And so also just knowing that a little bit of misspelling often grabs attention too. That extra I in the middle didn't hurt for some attention generating, but probably name it something completely different if I was starting it out today.
Eric, what is the 90-10 rule?
The 90-10 rule of cycles is something that I've been describing for many years, but I really tried to bring it back into focus last year in October and November. And at its core, it's really just another way of expressing a parabolic move. But getting a little more specific with that, it's a little bit of a variation on the 80-20 rule, but when applied to cycles and market moves and market trends, where in particular markets, and I see it predominantly in equity markets and in precious metals, you often see 90% of a move, a particular trend, in the final 10% of a cycle. In specific weekly and monthly cycles that I use, I've seen this really adhere to that principle. And it could be attributed to a lot of things. It could even be just the complete predominance of computerized trading, where everything moves so fast, and those big moves are often very reactionary at the end of a cycle. But the reason that I really focused on it last year was to point out what to many people might be intuitive, on the surface. And that is, if you're looking for a market to enter a downtrend and you're wanting to sell short a market, get on the short side, and the normal logic would tell you to look for specific highs using cycles, using other indicators, overbought indicators, other things that are telling you a reversal lower is coming. And there is some sense to that, but what I've seen with this 90-10 rule is, again, particularly in those markets I mentioned, that I'd rather be looking ahead at when a combination of cycles and other timing indicators that I use is telling me to look for an intermediate low, and then backing it up a little before that, you will often see 90% of the move, so in this case a decline, 90% of that decline in the final few weeks right before a cycle low. And that's when I want to be in and out of the markets, is when the moves are going to be bigger, you're going to your money's going to be really working for you, not just kind of sitting there a lot of times. And so when I discussed this back in late October, I cited two examples coming in the 3 to 6 month horizon. And the one was that because of some patterns that were already setting up in gold and silver, and some intermediate cycles that I thought were going to set a multi-month top in late January, early February, that the 4 to 6 weeks leading into that should be when you see the biggest upswing in gold and silver. So between early to mid-December and mid to late January. And then I look for other indicators to kick in and really confirm that for me. I'll never do anything just on cycles. They're just a backdrop for me. That was the one example I cited back in late October. And the other was looking at stock indices. and I explained how late January, early February was when I thought we would see a sharp decline begin to take hold, and that would lead into an important cycle low in March of 2018. And so, obviously, gold and silver, we can now look back at with 2020 hindsight, and they did almost exactly that, and the majority of their move was in the final phase of that upcycle. And now you have the equity markets doing the same thing. They started to generate some daily sell signals in the latter part of January, then some weekly signals kicked in last week, and that just ushered in this time for an accelerated sell-off, which I think will extend into March. So I think we still have more to it. But again, this is just another way of expressing a parabolic move, but there are a lot of specifics to it, and there's specific markets that it's most accurate in, and a combination of indicators I use to filter that and to tell me when to be getting in and when to be looking for a market to culminate those moves.
Is the S&P 500 trading in sync with the Dow?
They're trading fairly close, but you get, the S&P is a little more heavily oil-related or oil-weighted, so sometimes you get a little bit of a divergence there. And the Dow Industrials, although I do watch them closely and I use them for specific signals, they're kind of this overly bullish configured index of 30 stocks that doesn't always give you the truest reading of what's going on in the general market. But all in all, I'd say that they move pretty much in sync.
Does the NASDAQ have its own cycle?
It does, but they're really not that far off from the other markets. I think that it's, the rising tide lifts all boats, and I guess the receding tide takes them all down. But there are certainly times when the tech markets are leading some of these reversals. And really, when you speak of leading, it's the Dow transports that are usually the canary in the coal mine when you've got some periods of selling coming, and that goes all the way back to at least 1999 when they signaled a top and reversal earlier than the other indexes. And even this last time, I was explaining why they had hit some critical upside targets in mid-January at 11,200 to 11,400. That was where I was expecting a multi-month top. And they gave the first sell signals on January 23rd, 24th. And again, it was that early warning sell signal in the transport. So you do have some deviation between the timing of tops and bottoms, but for the most part, the trends are pretty similar.
How are stock markets around the world holding up?
Actually, that leads into another important indicator or lead type of indicator. And the markets that I'm watching the closest and which I think are the most vulnerable are the European indexes. And the CSE.V cash index is really one of the best indications of that. It's also corroborated by action in the German DAX and the French CAC 40. They're all doing pretty much the same thing. But that CSE.V index has not even gotten close to its peak of 2015. And this last rebound, ever since it bottomed in early 2016 with all the global equity markets, it had certainly a nice advance from there, but nothing to the degree that all of the other global indexes saw. And it peaked in May of last year, and then just more recently it retested that high, but was not able to close above it, and that was another one of those warning signs that I discussed a couple weeks ago. but its overall formation is one that shows a lot more vulnerability looking out to the future than some of the U.S. markets and even some of the Asian markets. So that's kind of has my attention. I kind of, keep one eye on that index and that whole region, because I think if there's going to be signs of trouble, that might be where it first materializes. And I've explained why I thought in that index you could see a year-long decline on balance. I need to emphasize that. It doesn't mean it's going down the whole time, but what I was expecting to see was a peak in the early part, in the first few weeks of 2018 in the Stocks 50, and its low for the year not coming until towards the very end of the year. I've got some specific cycles that I've discussed and published in my newsletter that I think could be an important low, but between now and then, just like that 90-10 rule we were talking about, as we get closer to that cycle low, that index becomes that much more vulnerable to an accelerated sell-off. So that is really the one that's got a little bit more of my attention for showing early signs of trouble. And really the key range of support that I'm watching is, it's a pretty narrow range, and it's between 2940 and 2970 in the Stocks 50. The interesting thing to me about that range is that it provided support all through 2017. There was a key low there early in the year, and then in August, the market went back down to that. Even while most other indexes were setting ascending highs, the stocks was going back down and making a double bottom. But if you go back to 2016, that was where the market initially found resistance when it was trying to rebound, right around 2940 to 2970. And when it finally broke through that, a basic tenet of technical analysis is about previous highs becoming support, resistance turning into support when it's broken, and vice versa. When a key level of support is broken, it becomes resistance to any rebounds after that. So you've got this multi-year support and resistance forming right at that pretty narrow range, 2940 to 2970, and I think that's really going to be the inflection point for the Stocks 50. When it breaks below that and gives a weekly close below that, that could be when you start to see a little bit broader signs of trouble emerging.
What do you see ahead for gold and silver?
I am still expecting gold to be on a steady incline through 2018. But there again, that I'm describing something where you have a series of rallies and pullbacks, but I expect that the pullbacks and the subsequent lows are going to start to angle higher. You know, whereas you saw the lows in late 2015, late 2016, and then mid 2017, they were a little bit, each one was a little higher than the previous, but it wasn't really angling that much higher. It was also forming what some people refer to as a saucer bottom, just kind of a slow, gradual turning. In December of 2017, we saw a little bit higher low, and then I explained why I thought that gold should initially surge back up to its September high, which was 1370 in the April futures, and that's right where we went to in late January. That was when a 1 to 2 month buy signal really reached fruition. But I think that you're going to see some additional advances after gold and silver complete this pattern that I'm looking for in this latest pullback. They've both just dropped to key intermediate support levels that I published recently, down around 1309 to 1316 in the gold futures, and down around 1620 in silver. So they are starting to unfold in that pattern, but there's a couple of additional things I need to see over the next couple of weeks to tell me that another ascending low has been set, and that gold in particular would be entering a phase where I think that each subsequent rally could have a little bit more conviction to it and a little more acceleration to the upside, ultimately getting to the upside targets that we've been looking for 2018.
We'll have more with InsideTrack.com President Eric Hadik next on This Week in Money.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Eric Hadik. He's the president of InsideTrack.com. Eric, if gold is going up, what happens faster, the price of gold going up or silver?
I still think gold remains the strongest, and I know I've gotten this question, especially from the gold and silver bugs over the last couple of years, always citing the ratio between the two, and talking about the historic levels of that, and that they're so far deviated from that. Well, sometimes when a ratio like that really starts to deviate, it's because there's different fundamentals and different factors impacting it, and that could be a new normal. And so I still look for gold to lead the way here, but I do think that we have a limited inflationary period on the horizon, and I'm looking more at next year, in 2019, and that would be the type of time where silver could start to perform better than gold. Conversely, or in contrast to that, when we've got these times of uncertainty in the dollar that we've seen since early 2017, and now if these sell-offs in the equity markets turn out to be more than just a couple-week correction, and you start to get some concern there, they're the type of factors that really favor gold leading the way. And, it gets that safe haven premium. Even as silver kind of wrestles, you get some investors wanting to go into silver for the safe haven, but then at the same time you get, say the equity market did go into a corrective period, all of a sudden you've got the risk of a slowing economy impacting silver but not gold. And you've also got the edging up interest rates that we've seen for the last year and a half having more of an impact on silver than on gold. So I still think that gold is going to perform better, proportionally and relatively speaking, over the next 6 months. But I do think that there's a period in the next 1 to 2 years where silver is going to have that opportunity to shine.
Copper had an outside month to the upside in December. Is this predicting a bull market for copper and economic growth ahead?
I think that copper has been predicting and anticipating that for some time. So if it's true that a lot of these markets lead the economy sometimes even by 3 to 6 months, I think that copper has already factored in growth that we're seeing and might continue to see in the coming months. But I actually think that copper is showing signs of more culmination to the upside, completing a very kind of clear textbook 5-wave sequence to the upside and getting ready for a bit more of a corrective period. And I think that could last for some time in copper, because it really hasn't followed through much after that rally in December that you're referring to. And it very quickly got right back down below its October lows, and then back down, October highs, then below its September highs. So really what you've seen for almost 6 months now is a topping formation, a little bit of an expanding range, but each time it spikes to new highs, it hasn't followed through. So that's another characteristic of a fifth wave coming to a close and getting ready to enter a corrective period. Now, depending on the extent of that correction, that may be warning of something slowing coming out 3 to 6 months from now.
What do you see ahead for oil?
Oil has just completed a 6 to 7 month advance that you and I were talking about back in the third quarter of last year. And I had done some articles where it was kind of interesting to me, when you talk about different markets within a complex deviating, like we were just talking about with the different stock indexes, seasonally and cyclically in the oil markets, you'll see the times due to the crack and due towards demand for unleaded gas versus heating oil and vice versa, where they will trade very differently from one another, as would be expected. Well, when I wrote this series of articles back in July and August of 2017, I was pointing out that the thing I thought was interesting was that all of the markets I was watching, crude, heating oil, unleaded gas, and natural gas, were all telling me to look for a multi-month high in late January, early February. And normally, especially at that time of year, you might see heating oil and natural gas setting highs, but crude and unleaded gas might really be lagging. They might be in a trading range and have already set their peaks weeks or months before. So it was intriguing to me that all these, not just cycles, but different timing indicators, different wave calculations that were pretty reliable, were all showing that late January, early February time frame for a peak and a reversal lower. And so I even wrote at that time that just kind of threw out the question there, is this saying something about what winter weather will be like or something else with the Middle East? Well, we had all those markets. Really, unleaded gas and heating oil led the turn. They gave some 3 to 6 month buy signals back in July and August. Then crude corroborated that in September and October, and that confirmed the outlook and just kept telling me to look for January to be the culmination of that rally. But also, with the 90-10 rule, that's the time when you could see an accelerated advance into a top. And we have seen that in the last couple weeks, and crude went right into a combination of weekly cycles that were lining up on January 22nd to the 26th, and reached some extreme upside targets that I'd published. And so all those different measures of a market reaching an extreme on both timing factors and price factors were the final clue to me that a multi-month top was forming, and I think that the energy markets have an extended corrective period ahead of them.
Is the bond market bubble in trouble?
Well, I'm not sure when you ask about a bubble being in trouble, whether it's in trouble because it's bursting or because the bursting is coming to a culmination. But I do think that that you are seeing a steady topping phase in bonds, and I think I had sent this to you a few weeks ago, but I was describing this intriguing parallel between bonds and stocks that two instances in the last 30 years were really worth paying attention to, and that bonds were starting to look a little bit like the same pattern. And the two instances that I cited in that were 1986-87, where bonds had rallied for about 5-6 years, and then they peaked in early 86 and went through a topping phase for 6 to 9 months, then started to do a little bit more of a decline in the early parts of 87, and then started to accelerate lower in third quarter of 87. Well, up until August, September of 1987, every month that was viewed as a positive, that interest rates were going up because they were responding to economic activity growing, and that was bullish for the stock market. And you would hear that month in and month out. Anytime bonds took a dip, there would be either, Fed governors out there talking this up or other economic talking heads explaining how that was bullish for stocks. And for 17 and a half months, it was bullish for stocks, even as bonds sold off. And then in about a 1-week period, that whole thing just flipped on its head, and the one morning stock market wakes up after it had already been kind of topping and showing a little bit of signs of weakness, and all of a sudden everyone was worried about the declining bond market and raising interest rates, and boom, the market just fell apart. Bonds shot up, I don't remember how many basis points it was in the one day and the overnight trading, and that was the bottom in bonds. And then you fast forward to 1998-2000, bonds are selling off again after a prolonged rally. They're dropping again for 16 to 18 months, just like they had done back in 86-87, and they spiked to a new low in January of 2000. And up until that point, it had been viewed as bullish for stocks. Then all of a sudden, things turned. It wasn't as drastic in stocks. This was a more prolonged turn in bear market. But the bottom in bonds marked the top in stocks to the month in January of 2000. And what I was pointing out is that as we came into January 2018, we were now in the 18th month of another bond market sell-off, but bonds needed to drop to new lows for you to accurately be able to say they had been declining for 18 months. And it was in the latter part of January when bonds and notes finally sold off, went to new lows, and that was when I published some alerts and said, is this going to be something that spooks the equity markets just as it did in 1987, just as it did in 2000? And at the same time, stocks were already fulfilling upside targets and starting to show a little bit of signs of caution. And now all of a sudden in the last week, you hear last Friday, bullish employment numbers were suddenly bad for the stock market. And then yesterday, some more bullish payroll numbers were bad for the stock market. And so it's that similar pattern. But when you look out for bonds, I have, since the top, I've been continually tracing out this pattern that I think we'll see. And that late 2019 is when I think you'll see the culmination of this bear market in bonds. But again, going back to that parabolic principle, that 90-10 rule, it wouldn't surprise me if the latter part of 2019 is when you see more of the panic selling in bonds, interest rates perhaps spiking a little higher, and that might be in an inflationary environment, and that could be due to economic activity, or it could be based on different types of supply constraints or shortages in certain commodities that in the past you've seen can at least create a 6 to 12 month inflationary spike. So, or it could also be dollar issues, that if the dollar really starts to generate more worry and concern, that, do you get to the point like there has been in the past where all of a sudden the Fed, the U.S. Treasury feels like they need to defend the dollar a little bit with interest rate moves. So what the exact fundamental is, I couldn't tell you, but my work is telling me to look for a progressive bear market into late 19, but you could see the more damaging part of that decline waiting until mid to late 2019.
Do you see interest rates spiking?
Well, I guess I'd really have to quantify that to see what you mean by spiking, to what extent. I think that, again, we could see that bond move accelerate somewhat. That's also proportional to the last 5 to 10 years and the trend that they're correcting right now. And often those bond market sell-offs are in anticipation of actual interest rate hikes, and sometimes those hikes don't actually materialize. So the bonds often overshoot what ends up occurring in the actual physical interest rates. So I think that there is going to be that more accelerated move next year, but the degree of it, that I'm not real convicted on my expectations at this point in time. I really need to see what happens between now and a key time frame that I'm looking for later in 2018.
Is the Trump administration trying to unwind the strong U.S. dollar policy?
Whether that's a conscious or unconscious thing, I know that you and I talked about this back in early to mid 2016 when I explained how my dollar cycles were telling me to look for a major top in early 2017, and that if that was accurate, extrapolating that out, it had me suspecting that we were going to see a Republican administration in 2017, and that was even before Trump was the candidate, or the nominee. And so this has been a pattern since at least the 80s, where the dollar sees multi-year declines during Republican administrations and multi-year advances during Democratic administrations, and the last 10 to 15 years held true to that correlation. The dollar topped in 01 and declined all the way into 08, so through the whole Bush administration. It bottomed in 08 and kind of sat there and went through a bottoming phase for a few years, and then rallied into late 2016, early 2017, so it was in a bull market during the entire Obama administration. And part of that is different economic and trade philosophies, where Republicans tend to favor a lower dollar to increase exports and other factors associated with that. And part of it has to do with different fiscal policy as well. So it doesn't surprise me one bit that the dollar is declining. I do still think that May of this year, May of 2018, could see a pretty significant bottom in the dollar, and then we go into more of a sideways pattern for at least 3 to 6 months and maybe longer. But I think on the whole that a Republican administration tends to correspond with a declining dollar.
Can the U.S. dollar continue to weaken as interest rates move higher?
I think that's very possible. It all depends on the driving force and which one is acting and which one is reacting. If the dollar is continuing to sell off because of deteriorating fundamentals, then you would see perhaps some interest rate hikes to try and defend it, but that would be the interest rates reacting to the dollar movement. If the dollar doesn't have as convincing of fundamentals driving it any lower, then if you saw interest rates continue to go up, and that might be what creates a bottom in May of this year, you may have the fundamentals under the dollar stabilizing and another interest rate hike or two that then starts to bring money back into the dollar. So that correlation just goes back and forth. I don't think you can try to trade solely off of that or off any intermarket correlation, because the focus of traders and the driving force of those intermarket correlations switches very quickly. It just takes one thing to pop up that suddenly attracts everyone's attention, and all of a sudden there's a different correlation governing market movement.
If the U.S. dollar continues to weaken, is it bullish for commodities?
Yes, I think it would definitely be, at least for when commodities priced in dollars, and that fits with the scenario I'm looking for out into 2019. But again, as I said, a lot of times you may see the two, you may be expecting the two, and by the two I mean a declining dollar and rising commodities, but it doesn't necessarily mean that the declining dollar is what's driving those commodities higher. There could be other factors that are first driving the commodities higher and corresponding things that weigh on the dollar. But just as a whole, if you had a significant, prolonged decline in the dollar, yes, I think it would be bullish for commodities, and often, I'm really sounding like a broken record here today, but it's that same idea that the majority of that type of move will often come towards the end of a cycle and end of a trend. So if you have a multi-year decline in the dollar, the first year or two of that decline, commodities aren't even paying attention, because the dollar hasn't really broken to new multi-year or multi-decade lows, anything that would really drive money into commodities or start to support their price. But then as time goes on and as those commodities slowly build bases and start to bottom out, as many of them have been doing the last year or so, and then the dollar, drops, sees another wave down. Maybe it's its third or it's its fourth decline over a 2 to 3 year period, and maybe it's now dropping to new 8 to 10 year lows instead of just new 2 to 3 year lows. Then you start to get that point where it starts to generate more attention, and you suddenly get a sudden kind of yelling fire in the theater type of rush to the exits all at once, and you get those big moves, and often they're here and gone in 3 to 6 months.
Is there likely a commodity bull market around the corner?
I just go back to what I've said a couple times here, that I think that they are basing, that we are going to start to see some key commodities move higher in 2018, but 2019 is really when I'm looking at for a more sustained advance in a lot of those commodities.
Is the Canadian dollar likely to appreciate during a commodity bull market?
I have not really looked at that correlation very closely. So I would, if the dollar's declining and that's part of that factor, it could certainly help the Canadian dollar. But I haven't done enough work on that correlation to really feel like I could answer intelligently.
What sectors do you really like right now?
That's a good question. I do think that that gold is one of those, I don't know if you'd call it a sector or not, but one particular market that I think is giving a nice developing uptrend. I've also seen some of the grain markets that I expected to see some important bottoms set in late 2017, and they were able to remain above previous lows, which is kind of a key thing for a basing process. And my work has been telling me to look for an important intervening peak in mid-2018. So if that's the case, and if we've already seen a low, and I'm going to be watching several of the grain markets to start showing more signs of a developing bull market, and then it wouldn't surprise me in that April to June time frame if we see more of an accelerated move as we get closer to when a multi-month peak is expected.
Are you investing in cryptocurrencies?
I think that they have seen their immediate heyday. That Bitcoin has corrected almost to the kind of bubble bursting levels that I was looking for, down around 5,500. I saw it spike below 6,000 just in the last week or so. So it has certainly given up most of what I thought it would give up. But I think there's going to be, as you get more and more regulation entering that sector, and a lot of skepticism regarding specific exchanges and specific cryptocurrencies, I think that now you're going to enter that phase where they need to do kind of a new basing process, although it's at a higher plateau, and that then it will take some time before they become a really solid candidate for another big move up.
Germany and France say the G20 should take some kind of action about cryptocurrencies. Do you think government should get involved with it?
I don't know whether I think they should or not, although with the potential for even what you've seen with the hackings and the thefts, and either you leave it as this completely Wild West type of atmosphere and just tell everyone buyer beware, and if where you're holding your currency suddenly goes bankrupt, sorry, it's you need to accept that risk. Or if you want it to be a more of a valid, credible type of entity, you're going to need some accountability. I know that word regulation suddenly gets half the population up in arms, but it's what you need for accountability and what you need for a reliable market. If they want a market that the masses are going to accept as a credible entity, then it's going to take some of that regulation or accountability to some extent.
Eric, how can people find out more about InsideTrack.com?
Our website is really the primary location to find that, at InsideTrack.com with the extra I in the middle, InsideTrack.com. And also we post a lot of our archived articles, those that kind of correlate to the 40-year cycle that I've been talking about, at 40yearcycle.com with the numbers 40yearcycle.com. And through either of those websites, they can contact us, ask for some samples and other information.
Eric, thank you so much for being on This Week in Money.
Thanks for having me, Jim. It's my pleasure.
My guest has been Eric Hadik, president of InsideTrack.com. He was speaking to us from the Chicago area. Coming up, Mike Shedlock from Mish's Global Economic Trend Analysis. Next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Reaugh Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. I'm speaking with Mike Shedlock, editor of Mish's Global Economic Trend Analysis on maven.net/MishTalk. Welcome back to This Week in Money, Mish.
Hey, a pleasure to be back on.
The first big thing, the equity markets, a huge meltdown. Is this the correction people warned of, or is this just a bump?
Correction? It's funny you mentioned the word correction because I'm just looking at this right now. Roughly 76% of the S&P is down about 10%. That's what we call a correction. About 12% is in an outright bear market. About 56, 57 companies are down at least 20% from their highs. The overall indices, however, are still holding up. They're not quite down 10% yet. At least the S&P is not down 10% yet. For all the scare over inflation and interest rates, banks are actually one of the sectors holding up the best. But, Jim, I don't even think this is a down payment on what's going to happen. I think we're in for a very prolonged decline here, or a faster decline, or a bigger decline faster, one of the two. I think the long, slow decline here is more likely. I'm looking for stocks, these stock indexes, to sell up as much as 50%, and John Hussman thinks they're going to fall by 2/3.
And just a reminder to our listeners, too, this interview is 2 days before the show goes to air, so the numbers might be slightly different, but obviously if you're looking at a big trend, that's not going to change.
No, I don't think so. This is Thursday, but the stock market plunged, the VIX soared. We had that huge rally. Everyone thought the bottom was in. Guess what? Today's decline took out every bit of the recent rally. Seeing all kinds of wild stories here, Jim. People betting on the VIX. And I called this. I've been writing about this a number of times over the past few months about how everyone was plowing in these funds into these ETFs, into positions one way or another, that volatility was going to keep declining or not rise literally forever. A $300 million hedge fund in Europe blew up on this strategy. I saw another report where one individual trader said that he lost $4 million overnight, and someone said, well, prove it to me. He actually posted his statement online and did prove it. The guy lost his life savings. I'm seeing other smaller reports here, Jim, where people were borrowing as much as $10,000 off their credit card. They were putting it into these products, poof, overnight, gone. I think we're just at the start of these stories, and there's a lot more of them to come. And let's just say that volatility has returned, and I think it's going to be brutal here for a few years.
Well, Mish, a lot of people told me just before this happened that this would have been a good time. Take cash and sit back because we're obviously due for something like this to happen.
That's funny.
Did anybody listen?
Well, first off, Jim, it's a couple of points here. The world's biggest hedge fund manager, speaking at that last economic conference in Davos, Switzerland, he gave a speech there at the conference that anyone holding cash is going to feel stupid. Now, I'm wondering if he's feeling a little stupid here now from that statement. Perhaps not. But as to your question, can people get out? On an individual basis, yes. You or I could get out. Other people could get out. I can write about these things. A few people here and there can get out. But the deal with stocks is for every buyer, there's a seller. So if you or I sell, somebody else is buying. So somebody has to ride these things all the way down, no matter how low it gets. And people say, well, where did the money go? That's a question I get all the time. Where did the money go? Who made the money on this? The answer is no one. We're going to see days like this where, the market falls 2, 3, 4%. No one, there's a few bears that were betting against the market that made money, but most of this is simply a repricing fact. Think of it this way. You own a house in a neighborhood. This is a good example from the housing bubble. You own a house in a neighborhood. You bought a house for $400,000. Well, 1 month later, the builder says, oh, we're going to offer all these discounts, and in fact, we're going to sell this house for $300,000. So where did the money go? Well, the money didn't go anywhere. It just vanished into thin air. All these homes that were worth $400,000 yesterday are worth $300,000 today. No one made any profit on this. The money just vanished. The same kind of thing happens in the stock market, except for maybe there's a short seller who makes a little bit of money. But most of the time, what we're going to see here is simply a repricing effort. Stocks that were worth $20 a week ago are now worth $10 today, and no one made that $10. No one ran off with it. Stocks were simply repriced lower.
Does this make companies that went and bought back their shares at a very high price look stupid?
Well, yes and no. The reason why companies bought back shares is the stock price goes up, the earnings go up because of that. CEOs and top executives get paid on the basis of performance, so the earnings look better. The CEOs get bigger bonuses. The CEOs don't have to give it back when things crash, but from a standpoint of is doing this in the best interest of investors? Of course not. It's in the best interest of the CEOs and the people who are giving themselves stock options, and they cash them out, and they'll keep getting their stock options. The price drops, so they get stock options. They take those stock options and sell them as soon as they can, always getting their money off the table. So a very bad way to run a business from the point of view of investors, but a very profitable way to run a business from the point of view of the CEO and the top executives.
Well, if we think the boards are running red when it comes to equities, what about cryptocurrencies in this market?
Well, they've held up the last couple days, sort of surprised by that, but then again, I'm hardly surprised by anything. On the other hand, you look at some of these, and even some of the top players, the top 10 cryptos, there's about 1,500 of them now. I don't know who can possibly keep track of all of them, but just look at the top 10, and there's a couple in there down 60, 70, 80%, I believe. So they've got smashed hard. Now, they've rallied. Some of them are up. Well, they're up today, actually, at least a little bit, a few percent. But I think these things can head to zero. I don't see why they can't. It's certainly not something that's going to happen overnight, but there's no fundamental value to any of these cryptos. The claim is that, well, that they've got an asset that's scarce and people want to own it. It's artificially scarce. We started out with one cryptocurrency. There's 1,500 of them now. There's no end to the number of cryptocurrencies that anyone can create. Whether or not any of them ever get adopted in the marketplace, that's going to determine whether or not there's any value behind any of them. And that's questionable at best. If the central bankers decide they don't like these things, at some point, they're going to see to it that they cease to exist.
Is that one of the reasons why they fell in value? Is so many countries were saying they were either going to restrict, regulate, or ban cryptocurrencies?
No, not at all. People can point to that, and perhaps they can say that's a catalyst. I look at it this way, Jim: the supply of greater fools simply ran out. So you just happen to have some of these statements and crackdowns, coming out at the time. But we were well overdue for a major plunge in these cryptos for the same reason the stock market was. Now, people can blame the Fed, they can blame inflation, they can blame all of these other things. The fact is, we're in a bubble. We didn't need any excuse. We didn't need a catalyst other than sentiment changing, saying, you know what, maybe the stock market really isn't worth where they say it is. It's the change in attitude that's driven this back. I don't think we're going to see that speculation rekindled with Bitcoin, but perhaps I'm wrong. It might come back, and it might come back in stages. Like I said, Bitcoin's up today. I don't think the bottom is in. There might be some playable rallies. Clearly, there was one here. Some of these things are up 15, 20% off the lows, but you're playing with fire. They can easily decline and just keep declining, and that's actually what they ought to do.
Cryptocurrencies, are they a way to get away from central banks, or will governments use them to track your every financial move?
Well, that was the claim made by on an interview that I watched today, a video on Hedgeye TV. I've got it up on my blog, where a guy, made the claim along those lines that eventually, the central bank's going to come in, or governments are going to come in, and then they say, well, they don't want this competition. This goes back to something that I heard in 2013. Ben Bernanke said he wanted to study cryptocurrencies. Bitcoin was at $300 at the time. Now, I'm looking for that quote. I've been scouring the internet for hours trying to find it. I can't find it. Of course, the words Bernanke and study and Bitcoin are going to come up in hundreds, thousands of articles actually, and finding that exact statement is going to be hard. I failed to bookmark it, but I'm positive he said it. But reflecting back, at that time he made that statement where he said the Fed wanted to study Bitcoin. So that was an indication. That was probably a very safe time to buy. That meant, and they probably really did want to study this to see how it worked. If for no other reason, possibly than the Fed might want to do this, or governments might want to do them themselves. But that was a hands-off, we're going to let this thing go for a while, see what happens. All of this recent news about governments, whatever, clamping down, maybe it's the time the study period's over. And I'm actually going to write about this on my blog. It's an article circulating in my head here for days about the study period being over and classes started. And so it's going to be interesting. But the bottom line here is, as long as governments, as long as Bitcoin is not interfering in with governments, they'll let it go, providing speculation doesn't get too high, which it has, provided some other things. So I think we're starting to see a little bit of that crackdown. More is going to come on tax evasion basis, on money laundering charges. A lot of that stuff's going to be trumped up, but it doesn't matter whether it is or it isn't. I'm just looking ahead for what's coming, and perhaps the average person, the grandma that was buying Bitcoin at 20,000, well, you know what? I think she's got a bad taste in her mouth here now. I don't think that sentiment's going to return as fastly, as strong as it did.
Mish, thank you so much for being on This Week in Money.
Pleasure to be on, and look forward to next week here. Does the volatility continue? We'll find out, Jim.
Thanks a lot, Mike.
We'll see ya.
My guest has been Mike Mish Shedlock, editor of Mish's Global Economic Trend Analysis on maven.net/Mishtalk. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Mike Shedlock, and thank you for listening. Plus, a reminder at the end of the show, we'll have company showcase updates with American Manganese President Larry Reaugh and Carl Data CEO Greg Johnston. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, President and CEO of American Manganese. Welcome back to the show, Larry.
Well, thanks, Jim. It's always good to be back on the show. I know we missed last week, but I was at the Bloomberg conference.
And what did happen in sunny California?
Well, it was a great conference, and it was an eye-opener. Certainly it was the inaugural mobility conference of Bloomberg, and they had 300 invited guests from 20 different countries, all of them decision makers, and I did get to mix with some of them and to meet some of them, and we sat on a panel, and certainly now a lot more people from around the world know about our up-and-coming process on recycling. And I think it was good all the way around. I think everybody that went to that conference came out a winner.
Can you tell us exactly what the conference was about and who was there?
It was all about the new technologies, the battery industry, the demands on cobalt and lithium, certainly the new recycling attitude that's developing out there, where they feel that recycling is going to be much more progressive than has been indicated before, and so that's a great thing. I think that Bloomberg led the charge on that, and they're in the right spot at the right time. Certainly, we feel very honored to have attended that prestigious conference, and I think the shareholders can be proud of the company.
With the Congo's developing attitude towards cobalt mining, where they're just grabbing every tax penny they can, in fact, they're taxing by the handful, is recycling cobalt even more important now?
I think it's more important. Certainly it'll be perceived to be more important. I do feel that this move by the government and the DRC is self-defeating. I mean, we saw this in 1973 in British Columbia when every major mining company left the province for 30 years. So in the Congo, 10% tax on cobalt by itself is not that bad a thing. I mean, the price is up there, and certainly the country should, share in that rebound of the cobalt price. But I guess it depends on how they spend that money in one way. But the other part of this whole thing, which gets less play, is the fact that you get taxed on 50% of any profits over 25% of what your feasibility study said. That could be very harmful to producing companies out there. They were protected under an agreement for 10 years, and that agreement has been canceled. And now they want to tax the profits from anything that's over 25% of the feasibility study. Now, you stop and think about that. The feasibility study could have been done 20 years ago, 10 years ago, 5 years ago. And it certainly had less margins then. So that means everybody's going to get taxed a tremendous amount of money. And are they going to be able to keep operating? I don't know. Will new mining start in the DRC? I very much doubt it. Nobody's going to go into a regime like that. That's just all of a sudden has upset the whole country's infrastructure when it comes to mining. So it's very harmful. And what does that mean to us? Well, we can already see the cobalt price has jumped from 80,000 to 81,500 today, and that's always good because we don't operate in the Congo. We'll operate anywhere in the world, but the bigger the price, the better for us. On the other hand, the bigger the price, the more we'll see of substitution, and but that won't mean there'll be less cobalt out there. It just means less profit per battery. But there's already a great profit in the batteries. So is it going to be harmful? No. I think people looking for cobalt will suddenly see that American Manganese has some answers for them. And, somebody's going to step up to the plate and help us finance a small producer here pretty soon, I believe. And, it's good and bad. And, no cobalt, you're going to see less and less cobalt used in the batteries. It just has to be that way. And, but again, there's going to be cobalt out there. Cobalt won't be eliminated from the batteries as far as we can see, Jim.
Larry, can you maybe explain to our new listeners what exactly American Manganese does and what it discovered?
Okay, just before I do that, Jim, we have a financing going on. We were hoping to close, 60% of that today, and I just want to let everybody know that that's progressing well. And getting on to American Manganese. American Manganese is a critical metals company that is focused on the recycling of lithium-ion batteries, where we get 100% of the cathode materials back. And it trades on the Toronto Stock Exchange Venture under the symbol AMY. It trades in the U.S. under the symbol AMYZF and trades in Frankfurt under the symbol 2AM. We can be contacted at our website, AmericanManganeseInc.com, or you can phone me at 778-574-4444, or give me an email at LREAUGH@AMYMN.com.
Larry, thanks for the update.
You're welcome.
My guest has been Larry Reaugh, President and CEO of American Manganese. I'm Jim Goddard. We were speaking on February 9th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Greg Johnston. He's the CEO and President of Carl Data Solutions. Welcome back to the show, Greg.
Hi, Jim.
You have a new news release for us to go through. Can you maybe tell us what it's all about?
Yes, for some time we've been working on advanced AI capabilities to integrate into our platform. Big data, of course, is at the core of what we do, collecting billions of rows of information. In our case, environmental monitoring information, and distilling all that data into actionable insights for engineers, data analysts, that's delivered through web services and also through our SaaS-based application.
You have more partners or new partners coming online with you?
Yes, it's part of an EU grant, and we're working with the Gdańsk University of Technology. I have with me actually Piotr Stepinski, who is our CTO, who's based in Gdańsk. Piotr heads up a team of 6 data scientists, but is also working with the University. Piotr, do you want to just tell Jim a little bit about the gentleman that's heading up this big initiative for anomaly detection?
Yes, our lead is Tomasz Brodrick, PhD, and he was extremely excited about what we are doing, and he has a huge experience in machine learning and advanced algorithms in mobile robotic systems.
So it's great that we have this working relationship with the university. Obviously, it helps them, and in terms of applying what they're doing in their master's and PhD studies to the real world, and it also helps us, of course, because we have the added horsepower of having these great, very, very bright people working with us to develop the new solutions for the features that we're putting into our platform.
Greg, can you tell us a bit about the company, what it does, and what you hope to do?
Yeah, Carl Data Solutions is what we say is a big data as a service company. So what we do is we collect enormous amounts of information for our customers. Our customers rely on us to collect and consolidate this information onto a platform, and then serve up that information in through analytical applications or web services to allow them to make sense out of the information. We're currently working in multiple verticals. Water is one of them, but we're also moving into mining and fintech, and also some other related industries like oil and gas.
Greg, why are you creating these things?
Jim, we noticed that a lot of our clients are spending too much time on eliminating a bias in their data sets. A lot of the sensor information that is collected, of course, is full of anomalies. And that's due to things like surges in voltage from batteries, to sticks getting stuck in meters. All sorts of things affect this data. The analysts, in order to get a good report and build a good model for their companies, need clean information, need a clean data set. And what we feel is we can eliminate about 80 to 90% by introducing this technology into our systems with a feedback loop to allow for our algorithms to learn and become better at eliminating the bias in these data sets. This will significantly increase the overall operational efficiency and save a lot of time and money, and give us a huge competitive advantage over our competition.
Where is Carl Data traded, and under what symbols?
Carl is traded under the CSE under the symbol CRL. We're also on the OTC under the symbol CDTAF.
And how can people get more information about Carl Data?
They can call, they can send an email to me at greg@carlsolutions.com, or they can send an email to info@carlsolutions.com, and we'd be happy to provide them with more information on our company.
Greg, thank you so much for the update.
Thanks, Jim.
I've been speaking with Greg Johnston, CEO and President of Carl Data Solutions, on February 8th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.